If you like hot rods, then you're going to really enjoy this story. This is how we can really supercharge the HECM for purchase. Now, most of you watching are very familiar with the H for P or HECM for purchase. No required monthly payments, increased purchasing power, and also the ability to retain a portion of your proceeds from the sale of the previous home, which is all great. But the question is, how can you really make the H for P even more attractive, thereby supercharging it, right? And this is a really great strategy, maybe one that you're already aware of, but if not, you'll definitely want to listen. Now, older homeowners, they have, of course, accumulated a lot of home equity, and they could be in a really good position to relocate, which would stretch their retirement dollars, and that would be giving them the ability to reap the ongoing benefits of having their retirement funds last longer. Now, senior homeowners who are empty nesters, have a chronic health issue, or want to move closer to family members are typical candidates for relocation. And for others, it's the economic pressures of living in a high-cost state. I'm just going to say it, I live here in California, so that is definitely one. Now, what few homeowners understand is how the HECM for purchase can really be put on supercharge by moving. Just a few months ago, we covered the story on the HECMWorld Weekly Podcast of a couple who relocated and really moved into a lower cost state, and it did just transform their finances. They were able to get into a new home. So let's talk about those states. Where might they be? And we're going to go to, yes, ironically, Lenderful Solutions, who, by the way, still doesn't understand how a reverse mortgage works, but they list the 12 cheapest states in the nation with the lowest cost of living. And so this is in the order of cheapest to, well, the most expensive of the cheaper states. So the lowest cost state is West Virginia. Then you have Oklahoma, Kansas, Mississippi, Arkansas. Let's see what else we've got here. We've got Alabama, good old Alabama, Missouri, Iowa, Tennessee, Nebraska, Indiana, and Georgia. So West Virginia, by the way, has a very low median home price. The median home price in West Virginia is only $163,000, which is great. We can look at some of these other states. Oklahoma, about $208,000. Kansas, Mississippi, Arkansas. Let me see. Let's go down to Iowa here and see where we are. I've got about $213,000 as the median. So those are lower cost states. Now, bear with me for just a moment, and let's look at a scenario for a 70-year-old widower who sells his modest home in Northern California for $425,000. So that's a pretty decent home, but it's not a mansion by any stretch of the imagination. So by doing this, he is going to be selling that home for $425,000. And then he is going to have $350,000 in sales proceeds that he nets. That's after paying off a small mortgage balance and paying for the realtor fees. Then when he takes that, he's going to use some of that money, but not all of it, to do a HECM for purchase. So his portion of the down payment on the HECM for purchase would be $135,000. And then the and that leaves him $215,000, by the way, that he gets to keep in his pocket. And the HECM for purchase will finance the balance, about $77,000 plus. So this is a great strategy because the homeowner is not having to sink every dollar into the new home. Now, could they have paid cash? Absolutely, but they would be reducing their liquidity, which is really kind of risky in retirement because they may not have the funds when it's most needed for an unexpected financial shock. And if they put all that money into the new home, they may not be able to get it out if lending standards change. But it gets better. Now, his homeowner's insurance premiums are about 70% less than what he was paying in California. His property taxes are about half of what he was paying. And just groceries and everyday cost of living, those items are about 10 to 15% in Iowa. So by leveraging his dollars, by relocating to a lower cost state and using the HECM for purchase, he set himself up for a comfortable retirement, where if he had remained in California, that likely may not have been the case. With this in mind, you as a reverse mortgage professional may want to consider partnering, with local realtors, but also relocation companies. Relocation services are really big when it comes to reverse mortgages, and you could really tie that in. So relocation services, one is Caring Transitions, and we're going to take a look at that here real quick. So Caring Transitions, they have some great opportunities as well. It's amazing what an industry, cottage industry, no more. It is a big industry for senior relocation, which I think is a fantastic service. So consider partnering with a realtor or with a senior relocation service to really leverage and supercharge the power of the HECM for Purchase. Last week, I came across an interesting column in Yahoo Finance. It actually came from Go Banking Rates, and it's discussing 4 ways that a baby boomer can become house poor in retirement. And that's not a good thing, but consider this. You know that as a reverse mortgage professional that a lot of the baby boomers you meet, at least you hope to meet, are house rich but cash poor, which we can maybe solve that situation with a reverse mortgage. But what about those who are house poor? How could that happen after decades of home ownership? Well, this recent column from Go Banking Rates really sheds some light on the situation. So what is house poor? What is the definition of that? It's those who have purchased a home that prohibits them from affording anything else, really hardly anything else besides the cost of the home or the mortgage. So that's a situation where someone is house poor. I would also add to that equation, it's a situation where one has consumed their equity over time. So there's a general rule, they say, that your housing costs, especially in retirement, should be no more than 30% or just less than a third of your total income. So those that are house poor are most likely over that threshold. So some are struggling to pay their mortgage payments, property taxes, maintenance, etc., and they might be close to not even be able to afford those at all, which could put them at the risk of foreclosure. So here are 4 reasons that financial experts say that many older homeowners, baby boomers more specifically, are becoming house poor. And one is they are reluctant to downsize. So that is something that's usually tied to the emotional connection that a homeowner has to their property. They raise their family there. There's a lot of good memories there. And they may even have family in the area. But the column notes the main idea is to do your homework for your retirement, the main idea is to make your home work for your retirement, not the other way around. So if the home is becoming more of an albatross around your neck, then that's not really a good situation for homeowners. So that's one of the considerations is relocation. So a lot of people are not willing to do that. But if you have an empty nester or maybe someone who has a chronic health condition and they need to move, let's say, for a drier climate, these could be people that would be a good candidate for relocation. Now, they may not qualify for a reverse mortgage, but the reluctance to downsize and relocate is definitely one reason that many baby boomers are, house poor. In other words, they're cash poor probably and house poor. But let's look at the second. And this one is really no surprise for you reverse mortgage professionals watching who found someone is short to close. Why would they be short to close? They've owned their home for 50 years. Well, it's because they kept refinancing over and over and over again, using their house as an ATM rather than paying down their mortgage. And that has some short-term benefits, of course, but there are long-term consequences, as we know. The column notes that if these individuals had simply just been paying down their mortgage, well, then they would have had a paid-off home, which would really help them and improve their position in retirement. And so the story continues. Yes, it does. All right. So if they had simply stayed the course and paid down their house, they'd be in a much better situation. So that's the truth. We run into a lot of people that are just eating up their equity. The third reason is they won't rent out their home. So that could be renting a room. It could be renting an accessory dwelling unit, which would be more ideal because they're not in your home and they have their own privacy as well. The column notes the way to make a home an asset is to either rent it or some portion of it such as a bedroom or second unit, to leverage the equity from the house. Now, I've seen some reverse mortgage borrowers do this in the past, but the primary unit in which they live must be the larger of the two structures on the property. So a reverse mortgage borrower could get a renter to be in the accessory dwelling unit or the mother-in-law quarters and still have a reverse mortgage on their primary residence. That's another strategy for maybe a HECM borrower who's still finding themselves needing a little bit of extra income each month. And they dip into their savings. Can you believe that? It says, generally speaking, your home should be paid based on your income. Now, you shouldn't have to deplete your savings every month to try to keep up with your home expenses. In other words, you're robbing Peter to pay Paul. They note that the stock market can turn quickly, inflation can make items much more expensive, and your savings could drain much faster than expected. That, according to Aaron Gordon, the branch manager and senior mortgage loan officer at Guild Mortgage. He says, as baby boomers' earnings potential decrease, they should be able to make payments on their homes for the foreseeable future. In other words, you want to plan ahead that your income is going to be a little less. So are they affording it right now in their current situation? If you're struggling to pay on your home, you might consider a reverse mortgage. We would agree, of course, here on this show. Reverse mortgages allow one to borrow money from the bank based on your home equity. He also adds that they get a bad rap, but it's unfair. If you're 62 or older, a reverse mortgage, which you can use to buy a new or refinance a current home, potentially gets rid of your mortgage payments for life. So that's the four reasons that many baby boomers, older homeowners, are finding themselves house poor. I think, again, when you see someone short to close, you're most likely, especially with an older homeowner, going to look back and find out that they've refinanced their home repeatedly, and that's left them in a real predicament. So what happens when a homeowner's had a reverse mortgage for at least a couple decades, over 20 years, but then they need to move to get long-term care, that is, leave the property? Well, that was a question that was posed recently in Oregon Live, and let's just see what the reader had to write in to Liz Weston, who's a well-known financial columnist. She says, "Dear Liz, please talk about the issues that people can face when they have a reverse mortgage and need to move out to get long-term care. My mom's 94, lives in a small teacher's pension. She got a reverse mortgage in her late 60s to donate to charity. Very thoughtful, but because she thought she wasn't going to live past her 80s, right? So she's like, I'm going to give this money away ahead of time and utilize a reverse mortgage. Now she needs long-term care and doesn't have the funds for it. If she moves out, she's required to sell the home. Capital gains will eat up any remaining equity after that reverse mortgage has been paid." So Weston notes that a reverse mortgage, of course, can be helpful for those over the age of 62. That's the federally insured reverse mortgage. And then she talks about when the loan repayment is triggered. But, of course, the debt increases over time. Now, the one mistake that her mother, the reader's mother, made was not really believing that she could live to the age of 90. So let's just talk about aging in place. Now, we can look at the statistics. It says here in the U.S., a 65-year-old. So if you're 65 right now and watching, here in the U.S., you have a 25 to 30% chance of living to the age of 90. Can you believe that? Boy, you want to take good care of yourself then. Now, that's according to data from the Social Security Administration and the U.S. Census Bureau. And today, right now, about 5 to 7% of our population are those who are age 90 and older. Good Morning America. I remember the 100-year-olds, the birthdays. I love that segment. But a lot of folks are living longer thanks to advances in healthcare and medicine. And just, we are figuring out how to stay at least in one piece a little bit better. Of course, that brings a whole host of problems when it comes to the solvency of Social Security and one's retirement lasting long enough. But Weston says that maximizing on current income and saving too little and taking out a reverse mortgage too soon or applying too early for Social Security without considering the benefits and the consequences to the future is really a big risk. So she suggests to get her mother in touch with an elder law attorney. who can really look at the situation, and I would agree 100%. If you find someone in a situation like this who has a reverse mortgage and somehow you're contacted, maybe it's even your own borrower, definitely enlist the assistance of an elder law attorney because they can answer the questions about how she can get that long-term care that she presently cannot afford. Now, that could mean having Medicaid or Medi-Cal if you're here in California, which would cover those expenses. But of course, they're going to want to recap those expenses by a lien on the property. So this is a very interesting column about what can happen with a reverse mortgage after a number of years. And if someone needs long-term care and they just never thought they'd live until their 90s, because most of us just don't think that far ahead, these are a few of the options.